How you guys doing, Dev Nation? Today we're going to be taking a look at ETFs, what exactly they are, how they would be a good substitute compared to perhaps like individual stocks, some statistics and numbers to get you thinking about ETFs, and yeah, so let's get to it. Well, what exactly are ETFs? So to me, they are like just a basket of stocks that you can actually go ahead and invest in. So for example, right, if you want to go ahead and invest into a particular company, let's say you want to invest in Apple. So you would go ahead and look up AAPL, which is their ticker symbol or the name of their actual stock for that company, and you would go ahead and invest in that company. Now, what if you want to go ahead and do that with other companies as well? Maybe you don't know how to go ahead and read the numbers on stocks just yet. So I think an ETF is actually a really good alternative to actually go ahead and begin building up this habit of investing in the stock market. So the actual definition, I looked it up on Investopedia, is a basket of securities that trade on an exchange. So basket of securities. So a security can be any sort of investment, really like stocks. It can also be gold and other things like that. But we're just going to keep it simple to stocks. You could do like a gold ETF. I know a very popular one is GLD, which is a gold spider. ETF, exchange traded fund. So that's something you could always do if you want to do more into like gold and stuff. But for this example, we're going to mainly focus on stock ETFs. So with ETFs, they have a historic percent, like a rate of return of about 9.7%. So on average, about 10% per year. Now you can say, okay, with inflation and whatnot, since inflation is anywhere from 2 to 3%, it's only about 7 to 8% return per year. But that's still actually really good, a really great return overall per year. Not to mention if you invest into ETFs that also return dividends, that's also a nice little bonus as well. That's some compound interest doing some magic for you. So that's always nice to do as well. So a couple ETFs you can always try and take a look at. Of course, I am not a financial advisor. Please do your own research. But so a couple ETFs that you can take a look at would be VOO or VOO. You can also do the SPY, which is the Spider S&P 500. You could do the SPHD, which is the S&P 500 High Dividend Yield. So it's low volatility, so that means it doesn't go up and down so much. It's pretty consistent over the long term, of course, not day to day, but again, long term as in year to year sort of thing. And it produces a fairly high dividend yield or a dividend return, which again, dividends are it's just money that gets paid out to people who own the stock because because they own it, right? And so because that company that you've invested in, or in this case, the ETF you've invested in, they have so much money that they decide to go ahead and actually return it back to its shareholders, the owner being you, once you've invested, right? Another good one, if you want to do sort of like an international ETF, because remember, this is just on any sort of securities, but again, international stocks, you could do VXUS, and then another one is so with those with the ETFs, they can be, again, it's a basket of a specific security. So as we mentioned earlier, you can do gold. You can also do, let's say, the US S&P 500, so top 500 companies within the United States. You can also do the top 100 companies of the United States. So top 100, you could do OEF, which again, it just tracks the pretty much the performance of the top 100 companies of the US. And so again, with ETFs, what they really help with is if you don't know how to necessarily look at individual, choose out particular stocks, right, that you like, but you just know how to perhaps read the numbers or things like that, because it is a lot to first do. I mean, it takes time, right? I think an ETF is a great alternative to going ahead and building up your habits within investing within sort of the investment world, because I know transitioning can also be scary, right? You're taking your money that you would normally save up and just use a little bit of that money instead to invest, and I guess you could say risk into the stock market. But if you know what you're doing, then it's not really a risk, right? I mean, granted, there's always some risk because we don't know the future, but you understand what you're doing, therefore you know in the long haul it's not going to be that risky because it'll recover and such in the future, right? I mean, we can't control everything, but we can definitely go in knowing a lot more and being a lot more competent in what it is that we're doing and lowering and minimizing our risk by knowing what we're doing. So with the ETFs, what they help do is minimize the amount of risk you have to take on because it just tracks the performance of all these other different companies. Now, another great way to use ETFs is, once you've built up the habit of investing, you can, after some time, you can go ahead and pretty much, once you're consistent with investing, whenever the stock market's actually doing pretty bad, it's actually, I personally think it's a great time to actually invest in like a ETF, because you don't necessarily know when which companies are going to be the winners later on down the road. So, for example, back March 15th of 2020, when the lockdown was really announced and everyone was like freaking out, at least within like the stock market, within investing industry. I think that was actually a great time to actually invest in an ETF, because at that precise moment, we weren't really sure, okay, what companies we really thought were going to get hit hard and which companies weren't, right? And again, you can also do this with, instead of stocks, you can do this like with, energy sectors. Energy was the big one where it's like, oh my gosh, we're not going to use oil, and eventually oil went to like negative numbers. You could have also done an ETF where you invested into, again, this exchange traded fund, this basket of securities, or in this case, energy being like oil and things like that. And eventually, over the long haul, as long as you don't think oil, like as an entire oil market, is really going anywhere, you can pretty much bet because it sank, you put some money in, a little more than what you would normally invest, it would go up over time. It's just, it would also track both the winners and the losers. Therefore, over time, it would eventually go up in value because, the U.S., where the United States, we have companies, businesses that succeed, businesses that fail. So over time, if it's a business that fails, it'll actually get kicked off, and it'll go down in ranking. So again, it's the top. You could choose top 100. You could choose the top 500 companies, whichever you prefer. Again, there's ETFs for either one that you want to do, and again, there's also ETFs for international stocks and other securities that you want to do as well, that you can go ahead and pretty much just look up, and you can find a couple, and you can also take a look at the compounded annual growth rate. So that's how well it's been doing pretty much on average, depending on if you do like a 10-year compound annual growth rate, 5-year or 30-year, whatever. But you can pretty much find the average of its performance over the last X amount of years. So I do think that's something to take a look at if you're going to go ahead and look into ETFs. But yeah, that's pretty much the gist of ETFs and how you can use ETFs to substitute pretty much your habit of investing in the stock market if you don't want to invest or don't know how to invest just yet into specific particular stocks of whatever companies you want to actually go ahead and invest in. So I hope you guys gain value out of today's Money Talk Monday, discussing ETFs, exchange traded funds, what they are, a basket of securities. And wishing you guys all the best. I really hope this truly helped, and just thanks for tuning in.